Good morning, ladies and gentlemen. It's my pleasure to welcome you to our webinar today. We have partners with the experts from Forvis Mazars, and I hope you'll find today's presentations informative, useful, and interesting. So please let me start with some technical subjects. The cameras and microphones are muted for better stability of the transmission, but in case yours for some reason is still on, please be so kind and switch that off, both the video and the sound. If you have questions, please put them in the chat window anytime you want. We will answer them at the end of the webinar, or if the presenters would like to do it right after their presentation. Adjust the presentation and the speaker as you like. And if you encounter any technical difficulties, please put it in the chat window. We will try also to address them if we can address them from our side. We will send you the presentation after the event. It might take some hours or a day or two. And this webinar will be recorded, so you can listen to it after, some days, tomorrow or the day after tomorrow, whenever you feel the need to do so. So our agenda for today, together with our experts from Forvis Mazars, first part we have a brief introduction by Lucian Dumitru, who is the managing partner at Forvis. Then we go to the tax updates. You can see, well, every year it brings new changes, new elements to the tax code, and Christian Potesatu will tell you all about it, and not only what has changed, but also how that will impact your business. And the second part, it's the European Union Pay Transparency Directive, which has also given us a reason to have a lot of questions. And here it's Florina Andre Ilie, who is a specialist in this field, who will give a presentation and answer, hopefully, all your questions you might have on this subject. And well, before I hand over now, a few words also about us. We are Advantage Austria. We are the internationalization agency for the Austrian economy and the foreign arm of the Wirtschaftskammer Österreich, the Austrian Federal Economic Chamber, which is headquartered in Vienna, Austria. We have different activities over which I gloss over. You will see them then in the presentation. And basically our job is to inform, to connect, to advise, and also to position and help Austrian companies in their worldwide activities. Speaking about Romania and Austria, Romania is an important partner for the Austrian economy, number 14 as an export destination, and number 19 as the source of products and services coming from Austria. This chart only shows the products. You can see that basically in both directions the way is up, with sometimes slight differences, a little bit less, but we will see what 26 will bring. It's, well, you know, things are not easy right now. Our top exports are vehicles and parts, electrical and other machinery, pharmaceutical products, and iron and steel. Almost everything is growing in these fields. And on the other side, same thing. Electrical machineries, vehicles and parts, machinery and parts, footwear, and measuring and testing instruments. It's typical for developed economies that they exchange very many products among the same category. And this shows also the advantage of the European Union membership of both Austria and Romania. For investment, the numbers are equally impressive, maybe even more so. There are lots of companies from Austria active here in Romania, and the foreign direct investment, according to the Romanian National Bank, is over 14 billion euro, which makes Austria the second biggest investor in Romania after Germany. And for Austria, Romania is the number 5 destination as for foreign investment, and as such quite surprisingly high. And well, you can call it a fun fact, but it's actually more than funny. Austrian investment in Romania is bigger than Austrian investment in Italy, France, and Spain together, which shows that Austrian economy, the Austrian companies have shown a lot of confidence in the development of the Romanian economy. Our events for 26, here you can see them. Important is we will be having a delegation to the port of Constanța. We will have our annual spring networking event. We participate for the first time in the Black Sea Defense and Aerospace exhibition. The highlight of the year, of course, is the annual Export Day in Vienna. We are not only in Bukarest, but also our office in Cluj-Napoca is going to have a networking event on June 11. And in the autumn, there are several other events planned, as you can see, but precise dates are not available yet for us. You can find us here. And that's our team and our office. So let me now pass the microphone, the screen, and everything to Mr. Dumitru from Forvis Mazars, who will give the introduction to the technical parts of today.
Thank you, Stefan.
Please.
Good morning, everyone, and thank you for joining us. We are very happy to speak again in this business community. I think Forvis Mazars has been a part of the overall, Austrian business community for a long time. I think more than 15 years already. I think for starters, for those of you who joined for the first time our presentation in this forum, would welcome a moment to introduce you to Forvis Mazars. So we are a globally integrated partnership specialized in providing personalized professional services, currently in over 100 countries, with a very strong presence, especially in Europe and United States. In Romania, coming close to home, we are a one-stop shop. And we provide services in terms of tax advisory and compliance. We have HR advisory and payroll services, accounting outsourcing, audit and financial advisory, and specific personalized professional services as required by our clients. In respect of Austria, we have been expanding significantly, and nowadays we are also integrating legal services practice. So we have a cross-border perspective when it comes to investment from Austria to Romania, but also doing business from Romania and expanding into Austria. Yeah, I think to put our presentation into the context, we see currently that Romania, already from last year after the various elections, has been going through incremental changes in some areas or significant changes in others. Focusing on the tax side, would note that starting from last year, we have seen primarily incremental changes to the tax system, which has been driven by two factors. First is the one regarding the significant imbalance in the public financing of the Romanian state. Currently, Romania had actually last year had the biggest public budget deficit in the EU. So this is a significant driver for adjusting our tax system. And on the other, which I would say more positive, is in relation to the commitments which Romania has been taking to make a fairer, more transparent, and more modern tax system as part of the OECD accession process, which has been going for some years. And the expectation is that by next year, we will be full members of the OECD. So against this backdrop, we have two main areas that we will address today. First, in the first section, my colleague Christy will address and guide you through the most important developments for foreign investors, which we would say a lot of them are actually positive. Some of them may be less positive. We also have news on the additional compliance and reporting requirements which companies in Romania need to follow as part of the wider integration into the international tax system, which Romania is part of. And here, for example, we would look at the Pillar 2 obligations, which in the European Union have been advancing. And in the second part, my colleague Ina is going to address a very hot topic nowadays, especially for the HR professionals among you, in respect of the EU Pay Transparency Directive, the complexity, the requirements for implementation in Romania as part of the wider European initiative, which is currently undergoing. So please enjoy, and if you have any questions, we are here either during the webinar or as a follow-up after the webinar. We are very happy to answer and to support you. Christy, the floor is yours.
So hello everybody, thank you Lucian for the introduction. Going forward on some of the points Lucian highlighted, so I think all of us who have been in contact with the Romanian tax system have seen maybe the end of 25 and let's say the beginning of 26 a bit exhausting in terms of let's say new legislation, new procedures and so on. But again, we're trying to put, let's say, an optimistic view on this type of changes and highlight some of the most important items in our tax system here in Romania, which some of them actually have a certain degree of opportunity within, but of course this needs a little bit of careful planning behind it. So without further ado, I will just get into the topic. One of the most, let's say, important tax changes that happened in 2016 is related to the tax holiday system. So basically, the system's been available in Romania for quite some time. It's been widely used by taxpayers, and it basically functions like this. Certain eligible costs which are invested into fixed assets, into eligible fixed assets, mostly we're looking at equipment, can be exempt from corporate income tax. This exemption functioned by way of, let's say, not a definitive corporate income tax exemption, but rather a deferral of the moment where you tax that profit which you reinvested into equipment. And it means that the value of the fixed asset, which the eligible fixed assets which were bought, were basically allocated to a tax holiday reserve. Now, that tax holiday reserve became taxable once, let's say, a taxpayer used it to either distribute to shareholders, incorporate into the share capital, or actually using it to offset losses carry forward. Now, the change that occurred starting with 2026 is that this tax reserve is no longer fully taxable, and it's not fully taxable under a couple of conditions. So the first condition would be that this tax reserve is kept into as it was set up, and it's not used for at least 5 years from the moment it was set up. If that time period is kept, then taxpayers can use this reserve tax-free to use it to be incorporated into the share capital or to offset losses carry forward, or if the case may be, if the taxpayer wishes to distribute this reserve, then it's only 50% taxable. So this is rather a big change compared to the previous system, where this tax reserve was fully taxable upon the moment which you use it. The only important aspect to consider here is that the reserve must be kept untouched in the books of the taxpayer for at least 5 years. And the new provision also applies for those who have applied in the past the tax holiday facility, meaning that the 5-year period would basically start to be computed from 2026, regardless of, say, let's say, whether that reserve was booked more than 5 years ago. So the clock starts ticking from 2026. We see it as a rather important facility, because basically you get a significant tax break on any eligible investment into fixed assets. So most taxpayers would invest nevertheless in equipment, IT equipment, and so on. So it's a good opportunity to think ahead and try to plan and somehow reduce the effective tax rate on these investments. Going forward, another, let's say, important tax facility which was changed a little bit, and it was made a little bit more appealing, to taxpayers, is related to R&D activities. So the facility in overall has not changed, so it's basically still applicable in the same manner. So we're basically speaking about R&D activities that are applied by taxpayers for research, experimental development, and so on, under the same conditions when it comes to eligible costs, formal documentation, and so on. However, until 2026, this facility meant that taxpayers can benefit from an additional 50% deduction on the eligible costs for corporate income tax purposes. Now, the change brings an option to the taxpayer. So instead of having an extra 50% deductibility for eligible costs, they can now opt to get a 10% tax credit out of the eligible R&D costs. Now, if you compare the two, and if you look at the overall corporate income tax cost, you're basically comparing an 8% effective effect for the past provision and a 10% effect from this new option by using the R&D credit. The R&D credit also has an additional layer of flexibility rather than the old one. So the old one, when you got the additional deduction, it was in the year in which the costs were incurred, and it basically reduces the corporate income tax base. So there might be a situation where there is no, let's say, cash impact due to the fact that the taxpayer was in a loss-making position, just for example. But in the new system where we apply the tax credit, the tax credit can be offset from the corporate income tax payable, and let's assume that the tax credit cannot be fully recovered. The taxpayer has the option to carry it forward, and deduct it from future corporate income tax payables, or within a 4-year period can actually request for this credit to be refunded. So you're basically seeing a cash effect, and the facility gets used 100%. Yeah. So it's an interesting opportunity for taxpayers that are active in this industry and actually carry out this type of activities, as the tax efficiency is rather high in using this system. Moving forward, to the next slide. There is another legislative measures. It covers entities that are subject to Pillar 2. So when it comes to Pillar 2 and Romanian GAAP, taxpayers need for that purpose need to actually determine the deferred taxes. Deferred taxes have been largely undefined for Romanian GAAP purposes until now. So it was something that was not covered by domestic legislation, because nevertheless, Romanian GAAP does not provide that deferred taxes must be booked from an accounting perspective, but rather they represent an off-balance sheet item. Now, due to Pillar 2 legislation, where entities which are subject to Romanian GAAP need to compute deferred taxes, they added a description of this obligation. So for Pillar 2 purposes, starting with the financial statements for 2025, which are the deadline for submitting them is rather near, I think within 1 month. Taxpayers which are subject to Pillar 2 legislation must make a disclosure in the notes to the financial statements for 2025 of these deferred taxes. And as expected, these deferred taxes would be determined based on international rules, and in this case, it's IAS 12. So this is, let's say, a painstaking obligation that taxpayers which are subject to Pillar 2 need to do in a short period of time for reporting purposes. But the piece of legislation which adopted this obligation also provides, let's say, an opportunity for this type of entities, because starting with the financial statements for 2025, entities, local entities which are subject to Pillar 2 rules have the option to transition to IFRS. So they have the opportunity to use international financial standards. And regardless of whether, let's say, in the future, that local entity would have the obligation or not in respect of Pillar 2, it can maintain to apply reporting under international standards. So this may be an option for taxpayers and can bring some synergies and efficiencies in the reporting department. And I'm looking particularly at entities which are doing group reporting under international standards and local accounting under Romanian GAAP. And by applying locally the international standards as a reporting standard, rather than the Romanian GAAP, they can eliminate reconciliation between the two financial reporting frameworks and hence have an increased efficiency here. Moving forward, there were in 2026 a couple of changes with respect to minimum capital requirements for entities. The Romanian companies law changed a little bit, and driven by the fact that there are a lot of companies that don't meet a minimum capitalization requirement or have a negative net equity. The lawmakers changed a little bit the minimum share capital requirement for entities. So in the past, where we had rather low minimum requirements, now they increased slightly. So now we're looking at newly which is roughly 100 euros for entities that have a turnover higher than 400,000 RON, which is roughly, let's say, 80k euro. The minimum share capital is around 5,000 RON, which is a 1k euro minimum capital. And this is on the one hand the part that tackles share capital, minimum share capital requirements, but on the other side, there are some stricter rules when it comes to the net asset position of the company. So with respect to the net asset position of the company, the Romanian companies law had, since maybe forever, had a general rule whereby the net asset is evaluated based upon the share capital, meaning that the general threshold, which remains to be applicable and was applicable in the past, was that the net asset of the company must be at least half of its share capital. In case it's not at this level, then the company must act towards recapitalizing the company to meet this threshold. And there is a theoretical risk, and it always was there, but I guess it was not that frequently applied in practice, was that any interested person can request the dissolution of a company that has a net asset below half of its share capital. Now, this condition and this, let's say, consequence still remains to be applicable in the Romanian legislation. However, starting with 2026, they put an additional layer of restrictions, obligations, and consequences. So these new measures still follow the ratio that the net equity must be at least positive and at least half of the share capital. If not, and if the net equity position falls below this threshold, then the taxpayer, by the end of the year, must reduce the share capital to cover the losses carry forward. That's one obligation, and it's subject to a fine between 10K and 200K RON. Companies that are still in this position for more than 2 years would be bound to swap shareholder loans and related party loans into equity in order to recapitalize the company. Not doing so would be a fine between 40K and 300K. And one of, let's say, the most stricter restrictions that are applicable, if the net asset position is below that threshold, then the taxpayer cannot repay any related party debt. So this is rather important because this restriction applies not only to, let's say, pure repayment of related party debt, but also to taxpayers that are part of cash pooling systems and so on, which are subject to this restriction in case their net asset is not half of their share capital. So here is a measure that actually requires a swift action from taxpayers because it basically follows a first condition that needs to be that action needs to be taken within 1 year, since it is it appears in the financial statements, and the second one after 2 years, when taxpayers might end up doing a debt to equity swap. The fines are also material in this respect, and as a particularity, they are only applicable starting with 2027 by reference to the financial statements for 2025. So I guess here it's a matter of careful planning and looking at the net equity requirements going forward and try to simulate whether a taxpayer would end up in this position or not, and of course, what are the actions to be taken forward. Now, if we move to the next slide, here are some, let's say, less complex tax updates. So the first one is the minimum turnover tax. I think we know it from practice. It applies to companies that have a turnover exceeding 50 million euros. It's been applicable for a couple of years now. Luckily, 2026 is the last year when this tax is applicable, and afterwards, this tax obligation will cease to be applicable starting with 2027. The legislator also reduced the applicable tax rate from 1% to 0.5% for 2026 as the last year of applicability. So therefore, it is expected that the number of taxpayers who are actually subject to this minimum turnover tax reduced significantly. Second one is a increase of tax rates, and the most relevant one is the increase of the dividend withholding tax rate, so the standard Romanian tax rate, which was in the last couple of years increased from year to year. If we remember, it was 5% in the past. It increased to 8%, then 10% last year, and this year we're starting with dividends which are distributed, actual distributions that have happened in 2026. the tax rate is set at 16%. So a rate which is aligned with the corporate income tax rate and so on. Now, this moves us to the next point when we're looking at this alignment of tax rates. This alignment of tax rates basically excluded all disparities, especially where businesses are held by private individuals. So we're looking at a 16% dividend tax rate. We're looking at 16% capital gain tax. And we're also looking at a 60% corporate income tax rate. So basically this alignment becomes relevant in the M&A environment because it makes it more flexible for entities which are entering into an M&A type of transaction, where the difference between a pure share deal and an asset deal become more flexible when choosing between one and another, because the tax element now is, let's say, less important than when it was as compared to the past. Yeah, when we have nowadays we have all the tax rates aligned compared to the past, where dividend income tax was less, capital gain tax was less, and the corporate income tax was 16. So structuring this type of transaction became more flexible with this alignment. Last, let's say another good news in terms of applicable taxes, we have this special construction tax, which was enacted last year. It applies basically a tax on the net book value of certain eligible assets which are qualified as constructions. Nowadays, the rate is for 2026 is 0.5%. And luckily, 2026 is the last year in which this tax is applicable. So basically, starting with 2027, we have a reduced tax burden in respect of this type of fixed assets, and with let's say a less impact for certain industries which are asset heavy. And I think I'm looking here at the most relevant would be the renewable sector, where a lot of constructions were subject to this tax. Moving forward onto the next slide. Here we put two items which are important as an update from a tax procedural point of view, and one of the most important items to look at and monitor. One of them is the tax inactivity status of a taxpayer, which continues to apply as it did in the past, only that starting with 2026, there are two new conditions in which a taxpayer can become inactive. Now, when a taxpayer becomes inactive, it's rather painful, because the statute of limitation does not is suspended. The taxpayer is qualified as high risk, yeah, and partners dealing with an inactive taxpayer cannot deduct the expenses or the related VAT. So quite important not to fall into this type of category. Now, the two conditions which need to be monitored in addition to the previous ones are that nowadays, if the financial statements are filed with more than 5 months after the legal deadline, then the taxpayer becomes tax inactive by default. So this puts an additional pressure towards companies that somehow didn't manage to submit in due time their financial statements. And here it's not applicable only to, let's say, the 2025 financial statements, but we're also looking at the past, whether there is a financial statement that has not yet been submitted. yeah, if that would be the case. And the second condition is the fact that every taxpayer, legal entity or otherwise, would need to have a Romanian bank account. Not having a Romanian bank account, which is something that the Romanian tax authority can check quite easily, would mean, again, by default, a tax inactivity of the respective taxpayer. So good to monitor here, because there might be cases where certain groups used group bank accounts and so on, especially when, let's say, you're looking at a captive subsidiary that's only providing services and goods only to related parties and so on. So where they might use only a group bank account and not a specific separate Romanian bank account. So in those cases, those companies might need to have a Romanian bank account. And the last one, which is a bit painful, the threshold for registering and actually getting a tax number for a secondary office was lowered from 5 employees to 1 employee. So if there is a secondary office where 1 employee works, then you need to get a separate tax number for that specific place. That tax number, it's used actually for payroll tax compliance. Doesn't bring an additional tax burden, but it must be requested. And this obligation was suspended until the 30th of June. So by 30th of June, all taxpayers must request for each place with 1 employee a separate tax number for payroll tax compliances. Importantly to note here is where that in a local administrative unit, a town, and so on, a taxpayer has more than 1 of these secondary offices. They don't need to get a tax number for each of them, so they can actually get 1 tax number for that local administrative unit, that town, and that place be nominated to do the compliance for all the units that are in the same location. Okay. So these are the main tax updates which we saw as important for the business community. I'm gonna pass down the mic to my colleague Florina to give you a glimpse into the EU Pay Transparency.
Thank you very much, Cristian. Good morning, everyone, and I'm happy to be here and to discuss about this very hot topic. I would say the EU Pay Transparency Directive, which I'm sure you have all heard a little bit about, at least in the recent period, and which it may not come, let's say, in a proper timing, because indeed it comes with quite an effort from our side and quite of very many specific requirements, but I'm sure it will bring a lot of long-term benefits to us as employees, to us as managers, directors, and of course to our companies. And this is what we are going to discuss about today. In a quick nutshell, what is this EU Pay Transparency Directive bringing or changing in our organizations and our culture and remuneration system? So first, just a little bit of the background. The directive was published in 2023 at EU level. And it sets out the minimum requirements for pay transparency and enforcement mechanism to ensure compliance with pay equity and the principle of equal pay for equal work, so work of equal value. This principle is not new in our legislation. Actually, it has been for quite some years integrated, even starting with the Treaty of Rome in 1957, and also in some other EU directives. In Romania, we also have it integrated into the constitution, actually, and also in the Romania Labor Code. But what it comes with as a new thing is actually the mechanism of monitoring and reporting and of proving, right, that we actually as employers are addressing and respecting this principle in our organization. All EU member states are obliged to transpose it by 7th of June 2026, so actually very soon, after which its provisions will become legally binding. This is what is expected. Now there are two, let's say, big requirements that we need to very well understand. First is the requirement of the reporting, which indeed will be mandatory in phases, meaning that the employers with over 250 employees will need to report starting from next year, from 2027, on the gender pay gap indicators. There are some indicators that are actually specifically mentioned in the directive, and this is what we need to measure and report in 2027 based on 2026 salary data on an annual period. Employers with a number of between 150 and 2,050 employees will also need to report starting with 2027, but they will need to update and submit the reports every 3 years. And the companies with employees between 100 and 150 will need actually to start reporting in 2031 based on the 2030-year data, and they will also need to report every 3 years. So this is one of the let's say, biggest requirement. But in addition, there are some other rights for employees and mandatory obligations for employers that actually apply to all companies, regardless of their size. So even if you are, let's say, a small, medium enterprise or just a company with 5 or 10 employees, actually there are some requirements that we still need to integrate and to make sure that we understand and follow in our organization. Now, some of the key provisions besides this reporting that are under the directive requirements are related to the recruitment transparency, which is important to happen prior to salary negotiations. So the directive mentions that we can disclose the salary range for the position that we want to recruit in the ad, the promotion ad, or just before we have the interview. Some of the countries in Europe have transposed it stricter. I mean, they are obliging the employers to really put the salary range in the job ad. Some others have let the employers to choose. In Romania, for instance, the first draft have said that you can just mention it before, but just to mention it in writing before you have the interview with your candidate. Let's say that this is one of the biggest requirements regarding the transparency process. From the perspective of the internal pay transparency, it is very important to understand that we will need to disclose some of the salary range and average actually of the salary we pay for the work of equal value or for the roles that are of equal value for our organizations. And from this perspective, I would say that actually not only the companies with over 100 or over 150 employees shall measure all the indicators that they are mandatory also to report, but also the other companies should do this because at least one of the indicators should also be disclosed in case it is required by the own employees. Then another key provision that we should understand that follow is these open salary discussions, because actually in our labor contracts we should eliminate or limit these confidentiality clauses regarding the own salary. So our employees will have the right to talk and disclose their own salaries in order to check or verify, so to say, that they are paid on an equal manner. So this does not mean that everyone should be paid at the same level that have the same role, but that there are some equity principles behind, and that everybody understands and know that, and that the people that are doing the same work or work of equal value are more or less remunerated the same. Besides this, the directive also mentions that it is very important to have, first to have, and secondly, of course, to disclose it, career criteria for progression, for promotion, for pay salary increases, and of course that it should be gender neutral and transparent and objective for our employees and for the new candidates. So this means that actually if we have this criteria, to make it transparent. If we don't have that, let's create it and let's integrate it into a document so that everybody can see, understand, and know what to expect regarding their career progression. Another important element is the gender pay gap, which is actually a set of indicators, as I also mentioned before, that we need to report, and this should be measured and reported on base pay, variable pay, and total pay, so on more pay elements. And the target is to have any gender pay gap below 5%. So everything that is above 5% needs to be justified or needs to be corrected in time. And last but not least, the directive emphasizes the importance of involving the employee representatives and trade unions whenever they are with the companies into all these kind of pay equity system definition, system consolidation, and in the transparency process. Of course, they are also the ones that, so to say, will support any employee to be proved or to be receiving the information necessary for him, and also, of course, aligned with the directive that he is paid equally or in an equity manner and treated as such in the company. These are just all the requirements in a nutshell, and now I would like just to give you a little bit of a brief of the status of the transposition of the directive in the EU member states. Up to now, we have 16 drafts, so from 16 countries of EU that have publicly transposed it in a first draft, all the requirements of the directive. And I have summarized, let's say, a little bit of important or interesting elements that we could find in such transpositions. For instance, in Romania, we have this very first draft, like on the 13th of March, transposed. And a lot of comments have been sent out by the private sector and by a lot of experts. And of course, that now we are waiting for the final draft and the final version. It is very much aligned with the directive itself. Very few, let's say, a little bit stricter requirements. The institute in Romania that will be monitoring this implementation of that directive is Ministry of Labor, with the responsibility given to the Agency of Equity Treatment between men and women in Romania. So actually, we will have to send our reports toward this agency, and they will, of course, check and review that we are aligned with all the requirements of the directive. Austria and Germany has not made any announcement yet on this transposition of the EU directive. However, I also included here just a little bit of additional information regarding the gender pay gap at country level, because this could be also interesting and important to see. So actually, Romania has one of the lowest gender pay gaps, with 3.7%. So under, let's say, this 5%, quite acceptable. It's not really acceptable, actually, if you go in front of the court, but you will not receive any penalties as a company if you have this kind of gender pay gap below the 5%. And while Austria and Germany, of course, they have, let's say, bigger gender pay gap percentage, as we could see from the Eurostat 2024 data, the latest updates. The Slovak, actually, parliament has just adopted recently the legislation transposing the EU Pay Transparency Directive. So actually, They are the first countries who have adopted a final version of this directive locally. They also have quite a big gender pay gap. So a big, what does it mean? This means big, above, let's say, the average at EU level, which is 11.1%. So this is good news. In contradiction or in comparison, the Estonian government actually mentioned that they intend to delay the implementation of the directive, and Estonia is actually the country that has the highest gender pay gap in EU, which is 18.88%. Of course, this could be justified, so to say, because if we look at this high percent, maybe actually 2 more months, right, for the implementation, if they have not started any initiative before, are not enough to actually implement all these requirements and make sure that you align as an employer with everything that is in there. So it is quite a little bit understandable, maybe, but yes, we will be looking forward to see actually how they will adopt it in the long run. Czech Republic has also published its draft recently. However, they also expect to enter all the requirements into force starting with January 2027, and even some certain obligations they want to apply only for 2028. And I guess this is also related to their big gender pay gap at country level, who cannot really be reduced very quickly, because of course, as we can imagine, this data actually influences our budget, right, our salary budget, and in order to reduce it, of course, that we need to adjust this. I have also some other elements regarding the pay transparency in recruitment. So, for instance, as I also mentioned before, some countries have decided to make like stricter rules than what is in the directive, and for instance, Belgium, Lithuania, and France require indeed the publication of salary levels or salary ranges directly in job advertisement. Poland actually anticipated the implementation deadline, and from a recruitment perspective, they have applied all requirements starting with 24th of December 2025, and all the others regarding the transparency, reporting, and remuneration actually are to be finalized into a final version of the transposition. Equal work for equal value assessment. This is, I would say, the biggest effort that we need to put to align with this criteria, but I will speak a little bit later about this. What I would like to mention here is actually that in the directive there are 4 criteria that we need to use in our job evaluation assessment for our roles, unique roles in the companies, and France actually expanded this 4 criteria to 6 criteria, which is quite interesting. But of course, France, Spain, and some other Western countries, so to say, they have some other previous legislation that came with additional mechanisms to ensure equal pay and pay equity in the company. So actually, this directive is complementary to those mechanisms with complementing requirements. While, for instance, in Romania, besides this kind of principle that is integrated in some of the local legislation, we don't have or didn't have any previous mechanisms to ensure that we really respect this principle. Right to information. So as I mentioned, there are also some stricter rules for Romania in the first draft of the transposition. And for instance, this is related to the response time for any request for from employees regarding the pay equity criteria and average gender pay gap that we need to provide to them as a calculation. So actually, at the directive level, there was set a 2 months period for replying to employees' requirements and requests, and in Romanian transposition is 30 days up to now in the first draft. And also in France, as I mentioned, they have some other previous mechanisms, and one of them was actually to measure and to make transparent the gender equality index, which is a different indicator than what is now included in the directive. But this is also extending and complementing the directive, and this is an additional right to information, so to say, for the own employees of the companies. Reporting and corrective actions, actually France goes below, so actually all the companies with over 50 employees, so not 100, will need to report. And in Lithuania, data on pay gaps is collected and published in aggregate form by public authorities, and such increasing transparency at market level. So again, as a summary, we can see that actually all the countries are making some effort in this direction. Of course, that considering that we have only 2 months left for such a transposition and implementation, we can expect some delays from some of the countries, but I wouldn't say that this delay it will be like very long. And if you have not started yet, then our strong advice and recommendation is to start looking into it and see actually how this directive is impacting you, because there are a lot of requirements indeed that needs to be addressed. And to be honest, each and every company has a very different level of alignment from what we have seen up to now, because there are different maturity levels of the remuneration systems, different methodologies and tools that everyone is using, and of course different so to say organizational culture and openness and of top management, openness and transparency level, and this should be actually more or less aligned all to the minimum requirements of the directive. Moving further, I just wanted to emphasize in this slide actually that these legal requirements do lead to some organizational changes, and actually the 5 main impacted pillars of HR and of the operating models of the businesses are the recruitment process, because as I mentioned, there are some requirements directly related to the recruitment process. There is this compensation system. So actually this brings a lot of methodological requirements behind, and I will explain to you actually what you need to ensure to make sure to align with the directive's requirements and to ensure a mature and well consolidated remuneration system. Then is the reporting process. So you will definitely need to put in place a reporting mechanism, not only to report externally, but also to ensure that you have the calculations in the company whenever somebody is requesting such information, and that actually this reporting should not be done only once per year or once every 3 years, when the authorities are requesting, because actually this is your indicator that shows if you do have some gender pay gaps that needs to be addressed or not. So they really indicate if you have a system issue, something is not well consolidated in your remuneration system, or if you have just some specific outliers that you need to correct and address, so you will not be under this risk of discriminating in terms of pay internally. Then transparency and internal communication is actually a very important pillar, and I would say a strategic one. So even if you have very good practices, very good and solid remuneration system, very good and complete documentation, you still need to make sure that all of your employees understand actually how the systems work, are convinced that they are treated equally on this matter, and that of course the communication and the main messages are very much aligned at the company level. And for this, at least 3 stakeholders or 3 actors are key. So the HR team, top management, senior management, board of directors, and people managers, who actually are the first contact of and are coordinating their own employees, and most probably they would receive the first questions in this aspect. Last but not least, governance is actually also very important for this directive, because everything is around the salary system and the salary budget, right? Which is actually approved at the top management level. And we know that this is actually the biggest cost of any company. And all the pay decisions, from the recruitment to any bonus, variable pay, benefits that we distribute, promotion, merit increase, annual, increase, everything should be somehow aligned and respect all these equity principles. And the bigger companies we have in size of employees, of course, the more complex our remuneration systems can be. So this kind of governance and very clear controlling mechanisms are extremely important. This is also the first step, actually, that we encourage you to move forward with, meaning to have an assessment of the alignment of your company with the directive's requirements on these 5 pillars. And actually, in this context, we have defined self-assessment questionnaire, which I think have also been shared with you. And for those who have not had the chance to complete it, you can start with it and see more or less where you are at the moment, right, in the context of the directive and of each of these pillars, and how ready you are to prove your compliance. As I also mentioned, so the foundation of compliance is actually building an equitable remuneration system, and this is really key. This is the biggest effort that may be required, depending on where we are in our organizations at the moment, or this, on the other side, is also the key to alignment with all the requirements, because if you have this in place, like really aligned to the best practices and all the methodologies recommended, then I think 90% you have done your work. And the rest is really easy, because the rest is actually, let's say, some administrative and bureaucratic elements that we need to put together and let's say align in all our documentation, but actually this is key. And this is why I wanted just very briefly to mention you these 3 steps that actually are a best practice in consolidating your remuneration systems. So one is applying a job evaluation methodology. This is a mandatory step, actually, also according to the directive, because as I mentioned in the directive, we have 4 criteria that are important to use in this kind of job evaluation methodologies. And these are skills, effort, responsibility, and working conditions. 3 weeks ago, the European Gender Equality Institute has actually bringing support with this job evaluation methodology, because they have developed several tools for different sizes of companies to support actually have this kind of implementation. They are all free. Of course, they are not easy and they are robust methodologies, but they are a big support for any organization in this directive. Then salary benchmarking would be the second step. So once you have evaluated all your unique roles, so different roles in the organization, and you have arranged them hierarchically from this perspective, it would be good, of course, also to see what is the salary benchmarking in your industry and for those specific roles. I would like to mention that this is not a mandatory step according to the directive, but of course it is highly recommended if you want to have a robust and competitive salary system. And the third action that needs to be done for this remuneration system setup is defining salary grids or salary bands and have a base pay design with very clear principles behind. And this is, of course, also something that you develop according to some indications and methodologies, but also based on the outcomes of the first 2 previous points of the job evaluation, then the roles hierarchy in your organization and the salary benchmarking. So the average that is on the market, and maybe you would need to align to. Moving forward. it is important to let's say to see actually what are the main gender pay gap indicators that we need to report. So this is the average pay gap between women and men for both fixed and variable components. So we look at the gross salary, but we not look only on the fixed salary, but also to all the variable pay elements and all benefits that are quantifiable in cash. We also need to measure the median pay gap, which is a little bit different than the average in the formula, and actually they show complementary things in our organization. The distribution of women and men receiving additional variable bonuses, and also the distribution across each pay quartile, because actually this distribution could impact the gender pay gap, and it is important to see if this is impacted by an unequal distribution or which could be justified from this perspective or not. And also the gender distribution and of course gender pay gap, average and median for fixed and variable components for work of equal value. And it is important to understand that work of equal value, this does not mean only to classify the roles between the same team, the same department, among the same team department, but at organizational level, so the legal entity level. This means that we may have roles, for instance, after we apply this job evaluation methodology, we may have roles of equal value for us as a company, from instance, an IT specialist and a market specialist. Just a random example. This is just to show that actually we need to compare all these roles across the entire organization and not in each and every division. The directive sets this requirement to ensure equity level at the organization, equity at the organizational level, and also equity in pay and in opportunities and treatment. So all this data is very important because data doesn't lie. This is actually your proof and will be your proof that you are really respecting this principle. And if we move further, I would like just to show you some macro indicators at Romanian and Austria's level. So as I mentioned, the gender pay gap at EU level is 11.1% based on 20 and 24 data, which is a little bit less than 12%, which was the average in 2023. This is a good sign, right, that we are going the right direction. And if we are to compare Romania and Austria, we have the gender pay gap. So also, as I mentioned on the previous slide, 3.7 in Romania and 17.6 in Austria. However, if we go by public and private sector, for instance, in Romania, we can see actually a very big discrepancy. So this means that actually in the private sector, we still have a lot of work to do. And in the public sector, this is actually justified by the fixed salary grids that they have for years. And yes, usually they very much align to them. For Austria, actually, there is no data distribution between public and private sector, but actually also the overall percentage shows us actually yes, the discrepancy and that we may expect in our companies to have some gender pay gaps without even being conscious of them if we don't start to measure these indicators. Now, we have also extracted in this slide some of the gender pay gap per economic sectors because we can see also differences. So in the manufacturing, more or less, Romania and Austria has the same gender pay gap or very close, 18 and 16%. In construction, we have actually 11, but minus 11, we will put it a different color here. So this gender pay gap in Romania is actually in favor of women, and in Austria is just in favor of men, the 7%. ITNC, we can see very big gender pay gaps. Financial services, the biggest. And the real estate also quite big. There are also some other industries that have lower the gender pay gaps. I didn't include it here because actually these are, so to say, the main important sectors that need to maybe address with a more urgent matter this directive. I also included the employment rate because actually, as I mentioned, this can also influence the gender pay gap in each country. So we can see also that in Romania, the employment rate of women and men are actually below the EU average, while Austria actually is much better from this point of view and is very close or even a little bit above. You can see all this data and description in the right part of the slide, and actually we will provide you with this presentation and you can check it in more details. Moving forward, I also have a slide regarding the HR policies and processes impacting pay equity and transparency. I will not go into details for each and every because this is like a half-day discussion, but just to mention the main HR policies that you may need to review in the context of this directive. So, as I already mentioned, recruitment and selection, compensation and benefits, these are the key. But if you have performance and evaluation systems that are related to a variable pay, so bonus, then you need definitely to review it as well. The L&D, it is also important because indirectly you may give different opportunities for developing their careers. So, okay, men and women, but not necessarily only men and women. We need to look holistically to everyone and to ensure that actually we give the same opportunities to each and every employee. Then we have the promotion and career development. Actually, this is a specific requirement in the directive to have this criteria very clear for promotion. What does promotion mean in our companies, and what is the criteria that we will consider when we make these decisions. And if you have this kind of D&I policy, maybe some of you have been reporting on the CSRD and ESG directive, then you may have this policy, and definitely it will be a good time to review it as well, because from the equity perspective, right, we have extended requirements. So this is just for you to know that actually, indeed, the directive comes with its complexity because we have very many elements related to pay that we need to consider. Moving forward. This is just a more structure of approach of what I have already presented to you. So what would be, let's say, the key steps that we need to do and conduct in order to ensure for alignment and for compliance? First, definitely understand where you are. So do the readiness assessment. Start with this questionnaire or any other approach you consider suitable for you. Second, build a foundation for your pay structure. Check whether your remuneration system is really solid, is really robust, is really aligned with all the requirements of the directive, and if not, start with this and review it, because this would take the most of the time. Of course, this is also related to the size of your company, how many employees you have, how many different roles, but still this requires to apply the job evaluation methodology, maybe the salary benchmarking tool, redefine, so to say, or change a little bit your salary grids. So defining the policies and putting all the things together. So this would take, so to say, the highest effort from your side, and also the highest involvement and understanding and alignment at the company level. Then, of course, it is important, again, to do these gender pay gap calculations. Also at the beginning, we recommend of such project of compliance, and also afterwards, because they would indicate if you really have some systematic issues or just, as I mentioned, some punctual outliers that need to be corrected. Then policy review. So start, of course, with the recruitment and the compensation policy, but don't limit to them, and check also all the others I have mentioned in case they are related directly or indirectly with your pay decisions. Then communication strategy, very important into this context, to align and to agree on the main messages to send in the company, because we want this to bring more clarity, okay, and not more misunderstanding. And last but not least, line manager training. So if you have managers that are really involved in these pay decisions, whether in the recruitment process, merit increase, variable pay, promotion, right? They need to understand a little bit more of what does a remuneration system means, what would be the key equity principles that we need to respect, and how they may impact us even at the biased level. And they need to understand very well your internal processes and what they need to comply with and apply uniformly at the organization. We can see actually in many companies in Romania that there are some rules, but not everybody really respects them fully. So this is key, and actually we are happy to see in some sectors here in Romania that this is really taken seriously, and there have been a lot of requests actually in terms of training of the line management for some companies. Moving forward. Now, of course, there are consequences of non-compliance, so we can start this from, let's say, a fear-based angle, this initiation to comply with the requirements. And actually, there are a lot of risks indeed. So, of course, the first one would be the legal liability for any of our employee. Then fines and financial penalties. In Romania, the first transposition indicates a range of penalty between 2,000 and 6,000 euro per incident. So we would say that this is not quite much, but okay, if we have a big company and a lot of incidents, that this can be summed up. And also the biggest risk and consequence, I think, that could impact our business is the reputational damage. And this also can lead to erosion of stakeholder trust, and of course difficulties in recruitment and retention challenges that definitely we do not want to meet. But I would also like to turn your perspective on the benefits. So in the next slide, actually, I have mentioned also some long-term benefits that this directive is bringing. Indeed, this is not a quick win. So on the short term, indeed, there is quite a lot of effort that we need to put, and maybe it's not coming in the best moment of our businesses, of the world context, and so on. However, if we invest in this and we really address it professionally, there are long-term benefits that, as I mentioned, is not just us as employees and directors and managers, but also as companies, we will definitely see. And now, because we are not having so much time, I will not go through each of them, but maybe you will go through it afterwards. But I would like also to complement this slide with the next one. This is related to this equal pay certification and employer brand strengthening. So maybe you are aware that there are some equal pay certifications that you can get in Europe at least. We are partnering with the Equal Salary Foundation, which is a foundation from Switzerland, and who together with the University of Geneva and the support of the state have developed a very robust methodology of equal pay. That one is aligned with ISO 9000 quality standards, and actually it has been enforced by the European Commission. And this equal pay certification actually is a proof that you are compliant with this directive, with all the equal pay standards, right, regarding the remuneration system and the treatment of employees in your organization. And now, because I wanted to actually connect it with the long-term benefits, starting from this year in Romania, we also are auditors, equal pay auditors in this perspective, and we are working together with our colleagues from Switzerland and also with the foundation to offer such certification. So actually the foundation is offering the certification, but our role is to do the assurance and the audit itself. And what I could find out in the first projects I've been involved in this year is that actually there is a very big difference of engagement of all the employees and all the culture and atmosphere in the company, just because of understanding, respecting, and trusting that the company is actually really proving the pay equality and pay and equal opportunity actually in the organization. So this would really make a difference, not just for, let's say, communication and brand strengthening purposes, but also for some others that are maybe more important for us as organizations, or increasing engagement, involvement, efficiency, productivity, and retention, right, in our company. So for those of you who on the long term maybe would be comfortable and are quite very much aligned with the equal pay requirements of the directive and would like to subscribe for such a certification, just for you to know that there is such product. And actually this is actually quite well known and wanted in the western part of Europe indeed, where, so to say, the gender pay gaps are much higher, as we could see also on the previous slides, than in eastern part, or at least in Romania. I think I have one more slide only, which is like a closing, or it's not here. Maybe it will be at the end of the presentation, but just I wanted to mention that in this respect we have written a lot of articles, and we have done some studies detailed regarding the transposition of the directive. Yes, this is, thank you, at all EU member states. That one has been published at the end of autumn last year, and we are now updating it with new information. So if you are interested actually to check more details of the comparison of the transposition of the directive across different states and EU countries, please feel free to check it on our website, and of course we can also give you the link if interested. Thank you very much. I think there are some questions because I could see, but I'm not sure we will have more time to.
Yes, maybe I will start with the questions, and starting there with those which have been asked for the first part. So first question, which of the 26 tax changes do you anticipate will have the greatest immediate impact on companies' cash flow? Lucian or Christian?
Yeah, so I guess it's on my side. It's on my side of the table. So, with a negative impact on the cash flow, I think most of the measures have already been adopted. So, whether we're speaking about a increase in withholding tax rates for private individuals, as I said, on the alignment of tax rates, the increase of the VAT, and so on, I think there is room for the future in a decrease, especially to these tax facilities, and especially the fact that some tax measures are no longer applicable. So we can mention here the minimum turnover tax, which is in the last year of application, and the special construction tax, which I guess it has the most significant cash impact for who applied it.
Thank you. And the second question would be, is the reinvested profits benefit applicable when assets are bought through leases?
Yeah, so on the tax holiday facility, this applies to assets which are directly bought or assets which are part of a financial leasing agreement. So when it comes to leases, only financial leasing. However, as I said, the most important thing is to see whether that particular asset, which is, let's say, part of a financial leasing agreement, is eligible for this facility. And basically, we're mostly looking, or what most taxpayers actually apply this tax facility for, is technological equipment. So in equipment that is used in manufacturing, or smaller equipment like IT equipment, laptops, and so on.
Okay, thank you. So coming to the questions for the second part, let me start. Are regional pay gaps allowed? For example, salaries in Jahr, Sibiu compared to salaries in Bukarest for the same type of role, but in different regions.
Yes, this can be a justified pay gap, but not necessarily related to gender, but to role. Yes, because in these different geographic regions with different economic levels, it's just that this should be clearly mentioned, and also clear criteria and differences that you are differentiating between these parts of the country. Yes, for this, so this is also, as I mentioned, could be justified. It would also be helpful actually if you can acquire also some regional study that would prove the same, because actually all the national studies that I know and I have been working with are also doing this kind of macroeconomic analysis, and you could see there that indeed there is difference in salaries at all levels, right, between the main areas of Romania.
Okay, and further question, can individual performance, overperformance, or the length of service be a factor for potential higher salary?
Yes, it's just that it should be applicable to all the organization according to the same criteria. So one is, of course, the evaluation of the roles, based on which we provide a fixed salary. And here we can also take into account this tenure in our organization. But regarding the performance, then we are going to address it at a variable pay level. And for this, of course, that we can pay better those that perform better, and we can differentiate on this criteria. This is no problem. It's just that, again, it should be very clearly set and transparent in our organization.
Then can we selectively grant certain benefits like Christmas, Easter gift vouchers, reimbursement for tourist services, meal vouchers, if we have implemented some criteria based on which we grant them?
Yeah, so if the criteria are objective and gender neutral, of course, this is also a practice, so to say, to differentiate hierarchical between the roles. So maybe at some point the management or the middle management get some different bonuses than other roles. However, again, just make sure that this is again applicable to all the company according to the same criteria, which do not discriminate between men and women.
And is the pillar 2 calculated on local, which is HB1, or consolidated figures, HB2?
I think this is for Christian or Lucian.
Yeah, so I would expect that it's about the how you establish the say harbor. Yeah, when you are talking about the local or consolidated. So I think the answer is a little more nuanced. In principle, you look at the local results, although it can get quite complex when you look at the QDMTT. Because it's a matter of what is the accounting standard that you use for the local calculation. So I think it would be great if we can have a follow-up discussion on that. Yeah. So the first answer is local. Yeah, but it also depends. It can also go to the on a consolidated basis.
Okay, thank you. Sorry, it was so technical, I didn't know where to put that question.
No problem.
But
No, it's
by
fine. It's an international tax. Thank you.
yeah, so it's nice to have you all to answer. By salary, we understand gross salary and all bonuses, or gross salary and bonuses and all benefits.
Yes, everything at gross level. Yes, but we need to calculate the gender pay gap per total remuneration. So all this included, but also on each separate element as well.
Okay. And the GPG gap, well, it's in Romania overall, it's 3.7%. But all the sectors in the list are substantially higher. So how do you get the end result?
Yes, yes. So first, I did not include all the sectors indeed. So there are also sectors with much lower gender pay gap. I just wanted to emphasize where we may have bigger issues. And secondly, as you could see also in the public sector action in Romania, there is a much lower gender pay gap. And this is, of course, very much influenced by the gender distribution and also by the different pay structure, actually, that it is in the public sector compared to the private.
Yeah, so from my personal understanding, to get these high numbers down to 3.7 in some sectors in Romania, you would have to have a negative pay gap, saying that women in that sector
Yes,
earn more.
yes. Actually, this is the case of construction, where is a negative with 11%. I will color it differently just to differentiate, but yes, there is also this case.
Mm-hmm. And just another question from my side, because I'm an old person, so I'm used to have lots of male colleagues in my age group, whereas 20, 30 years younger, there are a lot of female colleagues. Now, with seniority, that means that the men are earning much more, and the more young women come into this job, the worse the gender gap gets.
Yes. Yes. So actually, as an employer, you can just prove that you really set an equitable setup for the remuneration pay, but also to give all these kind of opportunities and career growth process to everyone in the same level. Now, of course, that there are some discrepancies also in some kind of roles. In some industries, and also maybe related to these generations, right, that you have mentioned, but they need to be they should be justified if you are right, and they will be also proved together with the data from the market. So from this kind of situations where, of course, it may not be an issue of the employer itself, but also the industry and the trend, the market trend, we encourage to also look for public data to support your justification.
Mm-hmm. Okay, do we have any more questions? So then I would like, first of all, to thank you and Lucian and Christian for the presentations, which have been very interesting. And I would also like to thank our viewers and listeners for their interest. I've seen that most of them were willing to stay till the very end. And this shows that it's really a subject which is important to the business community. And I would like to thank you all for being here for participating. And I hope to see you in the future at some other event of ours, be it a webinar, trade mission, or also one of our events of a more social nature. So thank you, everybody, and goodbye.